I have no idea what we're going to talk about today. Just talk about shit, fake news, more bullshit to jam up the internet. Yeah, but that's just the point, is that young people are in the ideal position, in theory, to take on the risk of volatility, which is just one form of risk, because in theory, they're not going to be, those funds can grow and the benefit of compounding can go on for years and years and years, and that interim volatility is not going to impact them, and they can own a collection of growing assets and disregard the daily fluctuations for the ultimate prize of the growth of those assets as they grow as kind of components of the economy. And so somebody in their early 20s is an ideal person to make an investment, with the caveat that maybe somebody's trying to save for a house or something like that. And then if you're going to be taking your money and investing it in a house for certain in a year and a half, then you may be disappointed after a year and a half if you happen to need that money at a point in time when the volatility has caused it to be in a less than desirable position to be redeemed. But in general, young people are ideally positioned to withstand that. They have the benefit of the wonderful benefit of compounding for a very long period of time. But even people who are retired and have no longer have a source of income, they're still we're all living longer, and they still are going to need substantial amounts of money in their kind of last years to pay for whatever they need to pay for in terms of their care. And one of the risks that people have in not taking any exposure to the economy through stocks, real estate, or whatever, is that the impact of inflation will be such that they'll run out of money before they run out of time. And I've got lots of customers who, it's funny because I have customers who are in their 70s or 80s who are not interested at all in kind of setting aside money in deposits or bonds. They want to be fully exposed to the marketplace, and I have to kind of convince them to set some money aside for their immediate needs. I've got younger people who have all the time in the world and who in theory should be exposing themselves to fluctuating assets, stocks, bonds, real estate, whatever, and they're just risk adverse, and they're not interested in exposing themselves to that, and as a result they have to work harder, and they can be good workers and good savers, and that's how they'll accumulate wealth. Whereas somebody who has a greater tolerance for the volatility, yes, they can work hard, yes, they save money, but they're getting the tailwind of the compounding of higher rates of return, so their ultimate pool of capital is in all likelihood going to be much larger. And there's lots of studies that show this. People get stuck in what's happening this month or this year or even this three years, but over time, even in a simple index, the rate of return is going to be much better by participating in the economy than it is by simply owning fixed deposits at your bank.